Hello, I'm Ryan Lightfoot-Brown of Chelsea Financial Services. Today, I'm joined by Mick Dillon, manager of the Brown Advisory Global Leaders Fund. Mick, thank you very much for your time today.
No, thanks for having us on, Ryan.
Now, as part of your process, you look for superior customer outcomes from the businesses that you invest in. These are businesses that are solving a problem that no one else can. Your largest holding is Microsoft, a company many of us will know. But can you tell us what the superior sort of outcome or problem solved that Microsoft does, please?
Yeah, and actually, it's a really good question. Even at the start of that, the most important person in any business is always the customer, to your question, because if you don't have a customer, really, you haven't got a business. So if you're solving a problem like Microsoft does, why does your customer come back? With Microsoft, there's a couple of different problems that they solve really well. The first one is for people like you and me and consumers in general, whereby they enable us to have technology like email and spreadsheets and PowerPoint, and it's across all of our devices. So it's across your iPhone or your tablet or your computer, and you can share your documents with teammates. And for a not very expensive price of £8 a month, you can have your documents, or I can share documents with all my family, with all my work colleagues, and it makes us more productive as workers. So there's just a general technology efficiency there for really a price that is not particularly expensive. The other problem they solve, which is behind the scenes, is for small businesses, because they have a cloud business whereby you can now set up a small business and you don't have to buy your technology. You don't have to go and buy servers. You don't have to go and buy the infrastructure. You can literally rent it from Microsoft and get all the services you need to set up a business straight away without a huge capital cost. And those problems are enabling us to set up businesses, to innovate. And the problems that they solve are all about helping other people do their own innovation and solve other problems for customers. So it's a real infrastructure that they operate that helps solve problems for customers.
And also in the portfolio, you're overweight financials at the moment, which is quite an unusual stance for your quality approach that you have. Can you talk us through some of the opportunities here, in particular, sort of the emerging market financials, where you've got quite a significant exposure?
Yeah, and you're right. Financials is really interesting because when we can find a company that really solves a problem for its customer, then we want to invest. So I'll give you an example. We're invested in a company called Bank Rakyat in Indonesia, and they do micro lending, so very small loans for working capital to go and set up a business. They go around rural villages in Indonesia and lend to people who are outside the banking system. And so these villagers can then go and set up a motorcycle repair shop or set up a shop to sell noodles and consumer goods, and they give them the loan to set this business up. Now, of course, there's a massive social good here because by setting up the businesses, they're then lifting these villages out of poverty, and these businesses hire people, and there's a whole credit multiplier that we see. That is an amazing customer outcome. For number one, because you couldn't get a loan and now you can set up a business. They may not even have a job or a credit history more often than not. And in fact, quite frankly, they often don't even have a bank account. And so this is enabling financial freedom for people who otherwise have no access to finance and credit. Clearly, it's a social good. It's an amazing social good to go and help lift people out of poverty. And for us as investors, we get a company that is doing good for us as investors by doing good for its customers. And so when we think about this, they're very unique circumstances. There's that one. There's a retail bank in India. There's a company selling life insurance in China. This is not a top-down thing. This is not us saying, oh, we want emerging market financials. We're bottom-up, company by company, individual investments. But as you can see from that example, if you're selling life insurance in China with an underdeveloped social security system, you're really solving a problem for your customer there. So they're very unique in what all of these things do, but we get to share in the benefits whereby the customer benefits, and then as a shareholder, we get to share in that benefit over the long run as well.
And a lot of our clients and our investors ask questions at the moment around big tech, including sort of the valuations and the big run-up they've had in the last few years, and perhaps the threat of more regulation in the space. How do you think about these issues?
These are incredibly important issues. When we think about our investments, our biggest risks in our investment strategy are typically what we call supply side. So it's when somebody comes in and steals the customer. So somebody sells a better product or service than Microsoft, or somebody does better consumer lending than Bank Rakyat. And so for us, normally it's supply side. But you're absolutely right. Regulation, you need a license to operate in society, and companies have a bigger duty than just their shareholders. They're responsible to all their stakeholders, be it the customer or their employees or society at large. And so when we look at this, we think that we want our companies to be doing good. We want to do well by our companies doing well as well. One thing we do is we have an investigative analyst, and their job is to go out and investigate issues such as regulation. And Lauren, who works with us, has spent now over a year going down to Washington and sitting in on the congressional hearings for us to have a very deep understanding of what is going to happen and the changes in the regulatory landscape. And to touch on the valuation point, it's a really interesting question, because we've, as noted, as no doubt you have, there are companies out there trading on 40 times sales, 50 times sales. Well, just to put some context, what does that mean? That actually means that these companies need to grow 25% for the next 10 years or more and have a free cash flow margin of 40% or more forever. It's not impossible. Somebody will do it, but not all of them will do it. And so sorting out who's who and who's going to make it is, I mean, that's the job of an active investor.
And one of the sort of unique parts about your fund is that you use a third-party consultancy to analyze your investor behavior, help you recognize if you're making any sort of behavioral errors in your decisions. When thinking about last year, what did you learn about your decision-making during the pandemic sell-off and the market recovery afterwards?
Oh, this is such a fun question for me because this is something, Bertie and I do this every day. So we actually have two processes. There's the investment selection, how are we going to find a good idea, something good to invest in? And then there's how much capital do we put behind it? Like what weight should it have in the fund? And that's all about buying, selling, and sizing. And as a portfolio manager, there's a real skill in there that you can try and improve. And to your point, how do you get better at that? Well, you've got to measure it, and then having a coach, you get the coach there to help you improve your forehand in tennis. Well, same thing for Bertie and for me. And so when we work with the coach, the whole point is to go back and look at our decision making, both the explicit, we invested in 3 companies in March, right at the bottom. In 3 weeks, we invested in 3 new companies, and then we didn't even have another new investment for the whole rest of the year. So were those 3 decisions any good? But it's not just those 3 decisions. It's what about the other companies that we could have invested in that we didn't? So what's the opportunity cost? And one of the areas that we're working with our coach on now is not just the explicit decision-making of areas of commission or where we've done well in that area, but also where have we missed out? Where have we not done as good a job for our investors as we could have? And one of the most important things is to have a long time horizon. And I'll give you an example is back to this question of thinking about cash flows. When we think about cash flows for our companies, we're always thinking out 5 years. And the reason that we do that is most investors are thinking in the next couple of years, and the longer our time horizon, the less people are looking at that. And by the way, the more value that we can add as active investors. And so when we look out 5 years, we're sitting there saying, so long as this company delivers cash flow in this range, we will get a double-digit return for our investors. And that's the heart of our investment strategy is if we can deliver a 10, 12, 15% returns per year, then we will double everybody's money in 5 to 7 years. And so for us, when we're looking at these cash flows and looking at the lessons learned, one of our biggest ones from last year was time. Make sure you don't worry about the next 3 weeks, worry about the next 3 years. It's actually 5 years is what we look at. And number 2 is it's not just about the mistakes or the errors or the things you did right or wrong. It's the things that you could have done or should have done. And how can you get better at those as well?
Well, Mick, thank you very much. That's been absolutely fascinating. I really appreciate your time today.
Oh, no, thank you for speaking with me.
And for more information on the Brown Advisory Global Leaders Fund, please visit our website, chelseafs.co.uk.